Hi traders, welcome to this edition of Market Outlook, Trends, Risk Events and Trade Setups, brought to you by Vantage Markets. This is a weekly webinar where we focus on the key events, both technical and fundamental themes driving markets at the moment. Whilst I just let you have a quick look at the disclaimer, I'll just run through what we're going to look at this week. Firstly, of course, we'll start off just with a general overview of markets and a couple of the key near-term and potentially longer-term themes driving markets at the moment. We'll review some of the stock markets in the US, the S&P, the Dow, and the NASDAQ. We'll then do a deep dive actually and review some of the key big risk events of last week. Quite a few notable events there. Non-farm payroll, of course, US core PCE, inflation data, and a couple of other charts as well we think of interest around inflation. And we'll look at the DXY, the dollar index, and gold as well, gold technicals on those. We'll then also review Eurozone CPI data from last week as well. Not that massive effect on markets, but also good to review and check out ahead of the ECB meeting next week. We'll look at Eurodollar technicals as well. Before then, hopefully previewing the RBA meeting and the Bank of Canada meeting on Tuesday and Wednesday of this week, and also their major currencies, so the Aussie dollar and the loonie, the Canadian dollar. Okay, before we get to reviewing non-farm payrolls, actually, let's firstly just look at some of the markets at the moment. Really, markets preparing in a way for next week's key events of the year, really, or at least in the near term, going into the new year. Probably the policy meetings, of course, of the Fed, the ECB and the Bank of England are the middle of next week. This comes obviously after the strong US November payrolls and especially strong earnings growth. But interestingly, that failed to see bids in the dollar or a recovery in US Treasury yields. And we'll look at that really quite interesting phenomena after Friday's data. Global risk sentiment generally to start the week is on a pretty even keel for now. After its recent rally, in fact. Interesting, we think that currently we're at a point where, in a way, fears of inflation and the Fed are slightly fading, but fears of recession are not yet enough to lead to downside in stock markets. Regarding the dollar, that looks like it actually looks like the dollar's long positioning has now pretty much faded. According to the CFTC data, that's the futures positioning of the big players, if you like, in the market. The dollar's aggregate positioning against G10 currencies is now neutral and at the lowest level since August 2021. So does seem as though there's kind of limited room for position squaring effects to weigh on the dollar going forward, but we'll see what happens going forward into those big risk meetings, big risk events, next week. Near-term factors driving markets will be, or are at the moment at least, China's obviously opening up, optimism about COVID, although we think that might take longer than potentially what many people are thinking. And also we've had a focus on energy prices. They're rising this morning, oil up over 2%. Just looking at the driver of oil actually at the moment, EU nations agreed over the weekend the cap for the price of Russian seaborne oil at $60 per barrel. That's really trying to diminish Russia's revenues and really paving the way for a wider deal with the G7 countries. That price cap goes into effect comes into effect today, actually, represents a discount to the current price of Brent crude, around $27 or so. However, really, it's the risk of setting a price cap too low is that Russia could slash its output, and that would really roil markets. So it'll be important near term to watch for Russia's reaction to this week, after President Putin repeatedly said Russia will not supply oil to countries that implement the price cap. Could be a volatile week then, but at least the OPEC plus meetings out of the way. They production quotas were unchanged at its meeting over the weekend. But as I say, oil, potentially the markets will be looking at what the reaction is by Russia to this price cap. Otherwise, of course, on the demand side, we've got to focus on the possible, this Chinese reopening, of course, and then we also obviously go back to the longer term driver in a way, potentially about these policy meetings next week. US equities then, they closed fairly decently last week. We can see on the weekly chart actually, another decent close towards just off the highs actually, you can see. But interestingly, we've come up against now this technical resistance, at least the 200-day moving average, and also the longer term downtrend. So trend line resistance, if we go back, you can see going all the way back to the highs of this year, you can see trend line resistance now, that dotted line just above 4,000. We obviously closed above that key psychological level, but we're at a critical sort of technical juncture, if you like, with that 200-day moving average just above 4,000, and then trend line resistance, that long-term trend line resistance just above. If we do break above here, then we've got a couple of levels. We've got a near-term fib level around 4146. Obviously, then we get up to, say, the August highs at 4,200. Sorry, that's the late August highs. Before then, this August high, mid-August high, around 4,325. We're not overboard actually on the RSI, so interesting there. We could go higher, but as we say, critical juncture, levels of resistance and support potentially, and all really dependent on, if we don't get many drivers this week, then obviously those risk events next week with the Fed on Wednesday. We'll just look at the Dow as well. We always do, and the Nasdaq. Firstly, the Dow, interestingly, it's beating the broader market actually to a degree actually not seen in nearly a century. So the Dow is only down 5.3% this year, which obviously isn't normally a cause for celebration, but that performance really looks blockbuster compared to the broader S&P 500, which is off 15% this year, and then the tech-heavy Nasdaq, that's down just below 30%, 27%, I think, or so on the year. So Dow Jones, as we've highlighted in previous webinars, this outperformance of old economy, less rate sensitive stocks really that it has in its composition, is pushing, has pushed the average, the industrial average higher, and is way outperforming the S&P and obviously that Nasdaq. So yes, just checking out the Dow, actually that year-to-date advantage over the S&P is the biggest since 1933. So as we said, nearly a century or so, just under. And the Dow's lead over the Nasdaq at this point in the year is the widest since the year 2000. And also then, of the three main US indices, the Dow is the only one not in a bear market, and that's obviously defined as a drop of 20% or more from the recent high. We can see we sort of highlighted this resistance support level potentially over the last few weeks. That being the August high at 34,281. You can see there the dotted line. We've got up to there, and we're just holding above that now. If we just check out the weekly, you can see the close just above that level, and you can see this really sharp obviously sharp rebound and getting towards the highs. Well, firstly, we would highlight this, probably this high from April, which is 35,492, and then possibly then we're getting into these highs above 36,000. But we've got support, 100-day, 100-week moving average, that is, around, where are we, 33,500. And then near term, you've got the 100-day, sorry, the 21-day moving average around 33,609, which is sort of last week's lows around there. So interesting, again, levels of support resistance potentially for the Dow. If we just look at the NASDAQ briefly, we haven't got anywhere near the 200-day moving average. We're just touching the 100-day moving average. You can see 11,978, but we have got that trend line resistance from the highs that you can see here on the weekly. And that comes in just probably around, where are we, just above 12,000. So NASDAQ obviously not still struggling year to date, down 27% or so, but hopefully potentially, if the Fed obviously slows up on its rate hikes, then the NASDAQ would lead these indices, especially then the Dow, which is already up strongly. Potentially that has the next leg higher, if you like. But in some ways, many ways, that will need to be led by the tech-heavy NASDAQ, which will only be driven potentially by the Fed reining in those rate hikes. Okay, we'll just focus on now the last week's events, really. Some really key risk events, starting with the non-farm payroll. Here you can see the numbers, just a graphic of the main numbers, the headline 263,000 or so, beating the 200,000 estimate, 8th beat in a row, that is. Also October's numbers revised higher as well, so strong job creation. But the key number probably was the 0.6% average hourly earnings growth, wage growth, beating that estimate, and also the annual number smashing the estimate, really. I think it was 4.6%, came in 5.1%, and also a revision to the previous month. So really a big increase in wages kind of underscores the Fed's argument that more work needs to be done to get inflation under control. But of course, as well, then we've had, well, just reviewing these numbers, unemployment kept the same, 3.7%. Interestingly, the participation rate fell, so that kind of indicates this growing labor shortage, which is reflected then in higher wage growth. But in general, employment gains were broad-based across sectors, really pointing to how strong this report is really at this stage in the cycle. Revisions were good, and the Fed funds peak rate moved higher, but not massively really, and still under 5%. Interesting, really, because recession fears still linger. Market participants remain skeptical, really, about how long the strong performance in the jobs market can last if we do get slower growth. The reaction then, the market reaction for or after non-farm was really, really interesting. Great illustration, really, of how the year's dominant themes of higher rates and higher dollar really are under attack, and it kind of bodes ill for the dollar. If we just look at, in fact, we'll just highlight actually. Yeah, we'll look at the dollar first of all. And just the reaction, if we go to the 1 hourly chart, you can see the dollar popped higher on the initial headline beats, and strong wage growth. And you can see on the 10-year as well, so the widely watched 10-year US Treasury, this is on the 1 hour, then you can see rates, so the yield on that government bond, the Treasury, jumping from 3.5% up to 3.63%. So a big jump initially, and then a pullback down. So that obviously drove then the dollar and that jump higher, and then the pullback as well. So really interesting reaction to the strong data. As we've said, it's kind of an illustration, and it doesn't bode well for the dollar when it can't rally with a strong jobs report. Just looking at that NFP beat then, including prior revisions, it came in at 2.9 standard deviations above consensus. And that's the largest beat actually since July's numbers. However, despite a very strong initial reaction, as we just seen there, the day-on-day response was pretty mild, actually. The change in the 2-year yield, actually, which is most correlated to Fed funds, and also the change in the S&P was only half of what would be expected, while the reaction in US 10-year treasuries and the broad dollar index declined. And if you contrast that with, say, the dollar response to the soft CPI data a few weeks ago, that was roughly 5 times recent norms, and even misses in minor data like last month's PPI figures, normally kind of secondary data, really, that had a material impact on markets more than the NFP. So really interesting market reaction, and something to bear in mind going forward with some of the data. Last week as well, we also saw Fed Chair Powell speak, following 4 consecutive hikes, obviously, in the Fed funds rate this year. Powell really repeated his comments from the November FOMC and what we've heard more generally from Fed speakers over the course of the last few weeks. He said it makes sense to moderate the pace of interest rate hikes, and the time to moderate the pace of hikes may come as soon as December. So that obviously implies this smaller 50 basis point hike rather than the 75 basis point hikes we have been seeing. While he added, it seems likely the rates must ultimately go somewhat higher than what was previously thought in September with the FOMC projections. They were, if you remember, at 4.6%, the dot plot for next year. So Powell again saying that rates need to go above that level. He added that the Fed has made substantial progress towards sufficiently restrictive policy, but more ground is needed to be covered, and the Fed will likely need to hold a policy at restrictive levels for some time. Powell also emphasized that the length of time that the monetary policy will be kept at restrictive territory is far more important than the near-term incremental pace of hikes. So does a slower pace of rate hikes extend the cycle further into next year? Really interesting, because kind of economists took his comments to be slightly hawkish. There was no specific, but there was no real specific hawkish pushback against the market's pricing of significant rate cuts in 2024 that the markets had feared. Also, rhetoric previously used in the context of the risk of not tightening enough is now sort of seen in the context of the risk of over tightening. And we also saw sort of slightly better or improved confidence by the Fed in bringing inflation down. That sort of confidence seems to have risen, and Powell kind of expressed as well guarded optimism on the prospects for a soft landing of the US economy. So whilst, as I said, economists sort of took a slightly more hawkish hawkish bias to these comments, markets, in fact, acted differently, really. The markets rallied, financial conditions eased quite considerably, so equities rallied, yields declined, and real rates fell quite sharply. And that all pushed the dollar, of course, lower. Also, commodities, actually, they took the news positively. Oil, metals, precious metals, all moving higher. I think we just want to highlight then a couple of charts really to do with this speech, but also then to do with inflation. Just before actually we look at that, we'll just also highlight a couple of the data pieces from last week. So we had Thursday's two key pieces of data, actually. The October PCE inflation data, that came in softer than expected for the core month-on-month reading at plus 0.2% versus plus 0.3 expected, while the year-on-year level, that came in 5% as expected. But this message kind of confirmed that inflation may have peaked using the Fed's favored measure of the trimmed mean. That excludes the greatest outliers and takes the average of the rest. Inflation did indeed tick down slightly from last month on both the year-on-year and on a monthly basis. Of course, there's still a way to go, but potentially it's a bit important that the stripped down measure of inflation, really followed by economists, is no longer accelerating. We also had the Thursday's ISM manufacturing data. That's a gauge of the US manufacturing outlook. That fell more than expected. The main index falling to 49.0 from 50.2 last month. So into contractionary territory. That is, of course, below the 50 threshold. That's the first time since the pandemic outbreak. Also, the details on both employment and price pressures were weaker than expected. Prices paid actually plunged further to 43.0. Employment nudged lower to 48.4. So all in all, kind of given these outcomes, it's not surprising that Fed Chair Powell, well, the market at least, sort of presume that Chair Powell took a slightly more circumspect view on the outlook going forward. And interestingly, actually, let's go back to his speech. Actually, he provided some benchmarks for employment growth and wage inflation growing going forward. So he referred to 100,000 jobs, monthly job gains as the pace required to match population growth. So with any outcome lower than this level, increasing slack in the labor market. And then he said a need for wage growth to be 1.5 to 2% lower or below its recent pace to be consistent with inflation returning to the 2% target in the medium term. So a couple of pointers there, but we've got a couple of charts as well. We just want to show you as well with sort of around the inflation dynamic. Firstly, this one, again, not wanting to get too complicated, but this shows really the proportion of companies looking to raise their prices over the next 3 months. That's basically corporate pricing power. And you can see the orange line, it's dropped sharply very recently, actually, kind of probably reflecting some evidence of this softening demand. And if you see, then that's with the relationship with the core PCE deflator. And if that then follows, the grey then follows lower, then potentially we could head down towards, economists think, down towards 3% by the end of the first quarter, which means then we would certainly be getting towards close to the top for the Fed funds target rate. And then certainly if the economy, some of the data does roll over, we fall into recession, as many fear, then certainly corporate pricing power, then that will weaken further as well and contribute potentially then to inflation getting closer to the 2% target by the end of next year. So interesting chart, we think, corporate pricing power potentially pointing to sharp falls in inflation. Also, chart, always interesting to follow gasoline prices, probably the single most important outlier in inflation. That's been falling, of course, $5 we were at, obviously, just ahead of summertime, and that's fallen obviously down to below 3.5%, so below the level on the eve of the Ukraine invasion. Interesting, then that will potentially affect headline inflation, pushing that lower, and then it increases actually the pressure on other prices by really releasing money for household budgets to spend elsewhere in the economy. But really key, we think, just interesting, this chart pointing out, really highlighting this fall in gasoline prices, one of the biggest upward pressures in inflation really is now coming lower. Okay, just if we just go to, in fact, I just want to go back to the DXY really. So the dollar index, we pointed out, obviously, sorry, I've lost where I was. So yeah, a couple of charts there, inflation charts really pointing to potentially lower prices going forward. And then let's now look at the DXY. We've said previously seasonal trends are typically negative for the dollar in Q4. We've said that over the last few weeks. And certainly the entire yield curve we've mentioned is now inverted, and that's a recession warning light as well, which is flashing quite brightly. Of course, we've highlighted that previously. The dollar typically weakens in the early stages of US recession, and that potentially leads to broad pressures on the dollar in the early part of next year as well. Dollar has erased more than half its year gains on these Fed rate bets really, and we can see this fall. I think we're now sort of, after gaining around 16% or so, we're now sort of down to gains of around 7%, I think. And you can see really we've got a couple of support levels, that August low, and we've just dipped below that, and then obviously the widely watched 200-day moving average, we're below that as well. You can see, if you go to the weekly chart, we've still got these fib levels on here, and this 38.2, we're now below that, which is just above 105. So critical sort of was support, now resistance really. 105 level in DXY, moving lower. Then we've got 103.84, which is the 50-week moving average. If we just go to the daily, then yeah, not much support really. Potentially sort of in this June kind of area, but then we need to go lower, potentially to around number 104 at least near term for the DXY. If we now look at gold, obviously dollar has been a key driver, and there's been quite a few supportive factors really for precious metals in general. They continue to line up. You've got China's reopening, of course. You've got the weaker dollar, driven of course by lower US yields, bond yields, treasury yields, that is, and that's helped gold sort of push higher, run higher up to test the break of the key 1800 level. That's the first time we've sort of got up to there since August. You can see we did actually go above that 1810 today, but we're sort of oscillating now around the 200-day moving average at 1795. Again, support or resistance, interesting, probably driven by the dollar especially. And you've got these support levels around the August highs as well, around this 1800 mark. So critical level. US 10-year real yields, so those are the ones accounting for inflation. They've fallen to a 2-month low recently after hitting 1.82% in October. I think they're now down around 1.14%, but certainly a break above. If this 200-day moving average acts as support, then a break above resistance around 1800 means we could potentially go higher up to sort of 1840 or so, that you can see there. Interestingly, ETF investors not quite engaged as yet. So probably, as we've said, dollar and also treasury yield developments will remain near term drivers at least, with prices especially oscillating around this 200-day moving average, as we said, at 1795. Okay, next up is the quick review of the Eurozone flash CPI data from last week. Inflation decelerated to 10% in November versus expectations of only a moderate slowing to 10.4%. Energy inflation was the most important driver of the decline, going from above 41% to 35% or so, while food inflation continues to trend up. But if we look away from the energy price induced headline grabbing drop to 10%, the more relevant core measure of inflation hasn't actually budged and remains painfully high, actually at 5% year over year. That was in line with consensus, but really still elevated. And the ECB, the European Central Bank, has rightly shifted the focus of the policy debate to underlying inflation and its persistence, really being well aware that drops in the volatile headline can really lead to false dawns. So another episode in the energy crisis could easily push inflation back up again, and core inflation usually tends to adjust slowly to energy shocks. That means monthly data will be a focus. Food inflation, biggest contributor there, while a lot of the higher costs have not yet been priced through to the consumer. That said, certainly there's no evidence of a wage price spiral, if you like, and the environment is turning more recessionary in the Eurozone for sure. Regarding the ECB then report, the inflation report really strengthens the case for a 50 basis point rate rise in December after a series of 75 basis points over the past couple of meetings. But the market has been leaning to that slower pace anyway, actually, already in wake of the country readings we got at the start of last week. What does the ECB do going forward? We'll focus on that next week, of course, but potentially it's not done raising rates, and it's widely accepted, actually, that the ECB will have to move into some kind of restrictive territory down the road. But certainly the latest inflation data, this data has kind of taken the edge off calls for a larger 75 basis point, another one of those jumbo size hikes, if you like. This week, not a lot on the calendar in the Eurozone. A few comments by the ECB officials ahead of its meeting next week. Energy-related news certainly will be a driver with falling temperatures in Europe. And of course, that price cap on Russian oil coming to effect today that we've mentioned. Upside risks for energy commodities. Remember, that means downside risks for the euro. OPEC Plus, they held production steady, as we said, and they're not scheduled to meet actually until February. So the risks are potentially of a tighter picture in the energy market next year, which leads to higher oil and gas prices. That is a big worry for Europe, potentially with the energy crisis flaring up again, and that would mean the euro would struggle into the first months of next year. Technically then on the chart, different picture in a way. If we just go to the weekly, we can see weekly close was above 105.17. That's a 50% retracement of the 2022, this year's decline. So as we've just closed above that, then you can see potentially that pushes us higher towards sort of 106.50, 107 area. We've got the next fib level at 107.46 potentially, but we are getting towards the overbought sort of territory on the RSI. But support for sure is around 104. You can see here again the August high, and then the 200-day moving average as well should offer major support. That's just below 104, 103. 68 and 62 for the August high and the 200-day moving average. Interesting, you've got the 21-day moving average really pointing sharply up. That comes in at 103.26. So you've got the breakout really, and bulls really hoping to consolidate that breakout and push up above last week's high around 105. Okay, just briefly then we'll preview then the RBA and the Bank of Canada meetings. The RBA is overnight tonight. They are expected to hike rates by 25 basis points to 3.1%. There is a possibility, actually, probability around 25%, I think, in markets of the central bank maintaining actually the benchmark rate at the current 2.85%. So no hike potential there. But overall, the bank, in responding to the significant inflation challenge and the tightest labour market in 50 years, it's raised rates from the record low of 0.1% at the start of May, with moves at each monthly board meeting, included 50 basis point hikes for the 4 meetings, July to September. The RBA then slowed the pace of tightening at the October meeting back to 25 basis point increments, with that policy arguably moving into contractionary territory. Inflation, though, still obviously an issue, still too high. Annual headline inflation expected to hit the 8% mark in the December quarter, so way above the 2 to 3% target band of the RBA. And then interestingly, the latest data, they've been quite mixed, really. Employment change better than expected, unemployment rate that fell, but on the flip side, retail sales showed a surprising monthly contraction in October. They disappointed for the third quarter, but then wage price growth, that's accelerated at the last count for the third quarter to 3.1%. And that adds really to this inflationary picture, inflationary pressures, price pressures, and probably supports the view that the cash rate will be increased further. Interestingly, there are differing views as to what extent then rates will be increased. Local banks, they anticipate one more rate hike with a 25 basis point increase, taking the cash rate to the 3.1%. But then other banks, Goldman Sachs, I think they recently revised its forecast for the cash rate to peak up 4.1% versus the previous view of 3.6%. So expect some volatility on this decision, around that 25% chance of no rate hike. So 75% go for 25 basis points, or that's what's priced in, actually. For the Aussie, Aussie dollar, again, big move higher versus the dollar, of course, up around 10% from the October lows. Really on sort of the dollar decline, and then these hopes of commodity demand from China increasing with, of course, the easing of COVID restrictions. Technically, bulls will target the 200-day moving average at 69.19. That's capped upside, if you can see. Let me just take out a few of these lines, actually. Take out that. So we've got the 50-day in light blue, and then the 200-day, that's capped. The upside that you can see in August, also in June, it capped that upside. We sort of got through there in spring, but then came back below it. And you can see again, it capped the upside in sort of late October last year. So interesting whether we can get up to there, 69 and above. You've got the halfway point of the this year's, April downtrend, really. That's at 69.15 as well. So interesting level for bulls to aim at if we do push higher. Otherwise, we've marked in here the July low at 66.81. We sort of oscillated around that, and a fib level before that, the 38.2 at 67.39. So that could offer near-term support before 66.81. If the RBA say potentially do not raise rates by 25 basis points. Would be a surprise. Aussie would come off, but it'd be interesting with this Chinese driver, reopening driver, potentially trumping that. We will see, of course, with the Fed, of course, then the key driver of the dollar going forward next week. Also, then we have the Bank of Canada's decision on Wednesday. They've already lifted rates by a cumulative 350 basis points this cycle, but the consensus, well, it's split actually between a 25 basis point move and a 50 basis point move. It is a fine call. A 50 basis point move, it's a statement only meeting, would take rates to 4.25%. The market and analysts are split. So just under half of analysts surveyed by Reuters, they're just looking for a 25 basis point move, but money markets are fully pricing in that quarter point hike with around 39 basis points of tightening priced in. So edging towards a 50 basis point move in swaps markets, in money markets. Prices actually firmed up after Friday's jobs data as well. That showed elevated wages and lower unemployment. Then overall, essentially, if we're looking at the economy in a wider sense, it's sort of, there is resilient economic growth and still high inflation. That's obviously then vying with this slowdown in the domestic housing market and concerns about high household mortgage debt. So traders will be looking out for any guidance about how close the central bank is to ending its hiking cycle now. The Reuters poll noted that although there was no clear consensus on where rates would top out, the majority, I think 26 to 29 surveyed, see the terminal rate at 4.25% or higher. But that all suggests then the Bank of Canada could either be ready to conclude or really close to concluding its rate tightening cycle. And in fact, in October, Governor Macklem, he hinted that the end of the cycle was near, but we are not there yet, he said, I think. So certainly neutral guidance by the Bank of Canada could weigh on the Canadian dollar. It is a statement only meeting, remember. So for the Canadian dollar versus the US dollar, and that is dollar CAD, of course, chart signals slightly mixed, with sort of range bound, have been recently. Dollars grind higher from the mid-November low, has extended a little further, but last week's gains above 136 really to 136.45, they were met with firm dollar selling pressure. And the 50-day moving average, you can see there, 135.65 now, that capped the upside as well. Key support remains probably around 133.80, 133.90. But if we do lose that, then potentially we go down to sort of 132, 133 level. The 100-day moving average, if we just change this one, is next support level around just below 133. That's for dollar CAD. Okay, lots to look forward to, really. There's still a lot going on for sure in markets before we get to obviously crunch time and of course, those risk events next week. A couple of central bank meetings this week, of course, and then we've got the Chinese driver and oil prices as well to potentially look out for this week. Okay, please do follow us on social media. We do cover markets, obviously, with the daily market commentary as well. And we look forward to speaking to you next week. Okay, take care.